Good afternoon, welcome to LBMA webinars. Today we have our first Hot Topics webinar of 2022, and we are talking about Russian gold, NSFR, and the US yield curve's recession warning. We have four incredible panelists today. So we'll have Adrian Ash as our moderator, we'll have David Gornall and Neil Harby from LBMA, and Rhona O'Connell from StoneX Financial Ltd to talk to you about these topics. So before I hand over to Adrian for the more formal and extensive introductions about our panelists, I'll just take you through a quick housekeeping slide. As always, if you have any questions, we're more than happy to take them. Please drop them into the question tab at the bottom of your screen or at the top, depending on which version of Zoom you are using. If you can't find it, can't see it, or don't know what I'm talking about, just drop us an email at ask@lbma.org.uk, and we'll either make sure to get the questions to the panelists during the webinar or afterwards if you are watching this back later as a recorded webinar. So Adrian, when you're ready.
Thank you very much, Taylor. If we can move on to the next slide, please. So good evening, good afternoon, good morning to all of our friends and colleagues and competitors around the world. I hope you are well. And if you are not, I hope you are swiftly recovered. We're looking at three very hot topics in the bullion market today. Two of them very specific to our area. One of them very much more broad in its impact and potential significance. But again, very relevant to the gold market in particular. In a moment, we're going to take a look at NSFR, the first 3 months, with David Gornall, Senior Advisor to LBMA. Rhona O'Connell, Head of Market Analysis London for StoneX, is also going to give us her thoughts and analysis on what's been happening in the trade data, LBMA trade data, with regards to any changes in behaviour. We're then going to take a look at last week's yield curve inversion in US Treasury rates and the very common assumption based on history that signal sometime in the next 6 to 24 months ahead. We're going to take a look at that with David and Rhona as well. But to start, we're going to start with what I think is perhaps a very hot topic for many people inside and outside of our market right now, with Neil Harby, Chief Technical Officer at LBMA. And we're going to take a look at Russian gold and the move to the former list that was enacted on the 7th of March. Taylor, if we can move on, please. Just to give some context to the LBMA decision on Russia. Russia is, as you may well know, the second or third largest gold mining nation worldwide, depending on whose data you look at. It's also, of course, physically the nearest to London and also Zurich, the Swiss market. And the chart that we have here shows you gross gold imports to the UK. This is HMRC data. So this is looking at actual physical flows of metal coming from Russia into the UK. You've got the global total there, and you can see how that actually pretty much maps price direction. 2012 was very strong. 2013, there was a big drop because investors didn't want gold so much, so there was less gold piling up in London. 2016, there's a big rally in that on the Brexit referendum and the Trump victory. And then obviously in 2019 and 2020, when they performed very well, you had very strong inflows overall. The blue line shows you what proportion of those gross gold imports are coming from Russia. Now, the blue line, as you can see, is pretty much flat and pretty much zero at a couple of years earlier in the middle of last decade. You'll recall, of course, that in 2014, Russia annexed Crimea. And in the view of many Ukrainians, that's really since when Ukraine has been under attack from Russia. And the current invasion really began 8 years ago. There were sanctions from the West. Let's call them soft sanctions compared to what we've seen over the last few weeks as a response to Russia's latest aggression. In the gold market of that was that basically Russian gold didn't leave Russia. The Russian central bank bought about 80% of domestic gold supply between 2014 and 2018, 2019. Then as the situation relaxed a little bit in 2018, 19 through to 21, you had big inflows coming into London from Russia. Now, somebody has asked me previously, you know, is this gold miners and refiners trying to smuggle gold or get gold into London quickly ahead of sanctions? I don't think there's any evidence of that. I mean, you can see the upturn starting in 2018 through 2019. You had 112 tons gross imports of gold from Russia into London in 2019. That then went to 289 in 2020. You then had 264 last year, so slightly down. And that's interesting because Metals Focus, for instance, say that there was a gross total of 272 tonnes mined in Russia last year, and that's against 264 tonnes that came into London. Not all of those imports to London necessarily were Russian gold mined. It may well have been Russian refiners processing other stuff. But you can see that, Russia has become a very important provider of gold to the London market in the last couple of years. So, moving on to the next slide, obviously the Russian invasion began on 24th of February after a couple of weeks of clear signalling and a couple of days of escalation. The decision that was then made on March 7th. What decision did the LBMA make and why regarding Russian refined gold?
Okay, Adrian. Obviously, this was not just a quick decision was made. A lot of discussions were had within the LBMA and with stakeholders, and we felt that this was the right decision to make, to suspend the 6 Russian refineries, suspend them and move them to the former list. In that way, that those brands would no longer be accepted as good delivery into London. Quite quickly after that, the CME also followed suit, and then these brands no longer good delivery on the CME. But the point that we really want to make there, and we can't emphasize this enough, is that bars that were produced by these refineries before the date of suspension remain good delivery. The LBMA has never retrospectively applied a suspension or a movement to the former list. So I think that's the key message, that if that's the only thing I say today, is that those brands prior to that date remain good delivery.
Okay, well, we're going to see if we can get you to say some other stuff as well, Neil. But thank you for the message. I mean, I think it is a very interesting point, because, I mean, just to tie that off with regards to the action by the LBMA and the CME as well. Obviously, this comes within the context of Russia is a major commodity supplier in energy and base metals as well, and we know that the Western world particularly, is moving slowly. For instance, the UK have said, we're going to try and end Russian oil imports by the end of the year. But the LBMA and the CME acted swiftly and clearly on this. Not the LPPM though, for platinum and palladium.
Yeah, Adrian, obviously I am the Chief Technical Officer of the LBMA, and you would have to ask the LPPM on their thinking. So
okay,
I'll pass the book on. Just an interesting statistic. You look at Russia being either the second or third producer of mined material. If you look at our stats that we published the last year and the year before that, if you look at the throughput of the GDL refineries, which is approaching 90% of global output, Russia, because of a ratio of about 55 to 45 recycled to mined, the Russian output from the GDL refineries as they were would equate to about 5 or 6%. It would be coming from Russian refineries of the mined gold, mined gold. Just to put it in perspective.
Okay. No, absolutely. I think that's interesting because, on the chart that we just looked at as well, you've got about 25, 26, 27% of gross inflows to the UK last year coming from Russia. But as I say, I think the important thing to note on that is, of course, that Russia is the nearest major gold mine nation. Yes. China is the number one, and of course, bullion cannot leave China.
Yeah, so yeah, gold is not coming to London. Yes, a lot of the Russian gold is coming to London, but is it staying in London? If you look at the vault holdings, they've increased over the last few years, so there is more gold in London. But obviously, London is a hub for the physical metal.
And we don't know from the chart that we had earlier. There's no way of knowing, what happened to those particular bars. We don't know where they went. We don't know whether they came directly from Russia either. They may, of course, have gone via Switzerland and stayed in Bond for a month before they then moved into London. So. So that chart doesn't tell the complete
but it's a good opening.
Moving on to the next slide. Moving on to the next slide, please, Taylor, because I think what's interesting, that's come out of the decision, LBMA, CME, related bodies as well, But also last week, of course, we had the LBMA and World Gold Council Responsible Sourcing Summit, which is a fantastic event, very well attended, really interesting. And a couple of interesting stories came out of that, I think, from the big news-wise, Bloomberg and Reuters. Bloomberg noted in their story, just following the end of the conference, that obviously there's been some confusion, I think, Neil, would be fair enough, around the status of Russian brands, should we say, new bars versus existing, what is now on the former list, and as you say, is perfectly acceptable. But also similarly with regards to ESG, environmental, social and governance issues. The comment there from ARM around investment products and investment promoters saying, well, what we'd like to do is actually to have bars which are after 2012 or maybe after 2019, when the good delivery standards starting to include increasingly more and more responsible sourcing and ESG standards. What are your thoughts on that?
And I know that perception is out there, but the gold that's been produced since time immemorial, it is what it is. Yes, we've introduced ESG more since 2019, but that doesn't mean that the gold before 2019 was bad, or the gold produced before 2012 was bad. What we do have, and we have seen, is that features like, for example, the year of manufacture stamp or the month of manufacture stamp, which we introduced, certain funds and certain investment people, they want to see the bars that have been produced later, not just because of the ESG, but also because they have like date stamps on them. So we have seen situations where older gold bars are refabricated into newer gold bars because they have the newer features on them. And as you know,
right,
there was a program a few years ago where the US assay office bars were deemed to be of inferior quality. So there was a program to get
you
those.
Mean what everyone calls, you mean Fed melt?
I don't put that back in my head now. I try to avoid saying that, but yeah, the Fed melt bars. So, and what we're going to do is, and we hope to work with the market, is that there is a situation, there is an argument for some of the older bars should be reprocessed anyway. But to make sure that you can see what they are, the date stamps, things like that, I think it makes sense to be looking at how we can increase the number of the newer bars versus the older produced bars.
But in and of itself, melting to recast a modern era bar for the sake of saying it's now a new bar, I mean, it does potentially risk, I think as the first comment in the Bloomberg article there, it does potentially risk somebody being seen to try and hide the provenance of a bar. Potentially, I think the accusation of greenwashing, I think, is quite interesting as well with regards to, this is a new bar and therefore it is of a better standard.
Commercially, that doesn't make a lot of sense. Certainly taking a large bar and converting into kilo bars is very common practice. So you would use a natural process to get some of these older bars into the newer formats. It wouldn't make a lot of sense to do large scale conversion of large Russian bars into large your own brand bars. Doesn't make a lot of sense.
Okay, thank you very much, Neil. Moving on then. Topic 2, next slide. Thank you very much, To. We're going to come to David Gornall to help us understand what and why is NSFR. David obviously is Senior Advisor to LBMA on this and many other important issues. But so David, why are we talking about this now? Well, it's, the end of March marked the first 3 months of NSFR and other Basel III regs coming into play for the UK market. Is that right?
Yeah, we thought this would be a good time to have a little look because, as you say, this is the first quarter since we've had the implementation, certainly within the United Kingdom. So we thought we'd have a look at the trade data that goes alongside it. But just in case you thought you understood it, then clearly you weren't listening in the past. So we're going to run through it yet again. But broadly speaking, NSFR and LCR, the net stable funding ratio and liquidity coverage ratio are Basel III rules. And we're going to talk a bit about the HQLA as well, but let's talk about the rules first. So they do vary dependent on jurisdiction, but broadly speaking, we can generalize when we're talking about gold. But post-2009, prudential regulators wanted to strengthen banks' resilience to financial stress. So within the Basel III regs, there were two ratios that were developed to tackle these risks in a stress market scenario. So one was the NSFR and the other one was the LCR. So the net stable funding ratio was designed to discourage the use of short-term deposits that could be used to provide long-term loans. It's the simplest way to describe it. The LCR, liquidity coverage ratio, was designed to promote the resilience of a bank's liquidity risk profile. So it basically ensures that they have enough adequate stock of high-quality liquid asset that can be converted into cash immediately and easily. So the HQLA is a function of the LCR, sorry. So that's where a bank must hold 100% or more of its next 30 days of outgoings in the form of high quality liquid assets. So those HQLAs are divided into levels which represent the liquidity risk of those assets. So that the top level is cash and sovereign paper, and the next level down is going to cover some publicly traded corporate bonds that are above a certain rating. Gold doesn't fit into those two levels, unfortunately. And that's when we talk about gold not being recognised as HQLA, that's what we mean by that. And gold is grouped in the NSFR rules as a result of that, with all the other commodities being labelled as a low liquidity asset class. Now, the other reason that we wanted to bring this up today is because we were going to have a look into the figures and the trade data to see about the PRA. Should we start to have a look at that? I think
let's read Rhona's disclaimer first.
Yeah,
I wouldn't worry about spending too much time.
There we are. Thank you, Rhona.
But, so I'll just give you some framework here. So for those of you, the exception of the disclaimer. So when we were talking about the PRA carve out, so just let me explain what we meant by that. I mean, carve outs within prudential regulations are not unusual. There was a provision for covered bonds within the EU version of NSFR. And there is a separate rule with the United States when we're talking about the standardized approach to counterparty credit risk, or SACCR. So it's not unusual for individual jurisdictions to reflect within their rules the types of business that they're seeing across their banking sector. And of course, this is relevant within the United Kingdom, with gold being cleared and settled here. So the PRA carve out permitting interdependent assets and liabilities to be matched reflects what was stated in the Basel rules. So what that basically means is that a bank that is holding gold physically and has both an asset and liability linked to that gold with its customer can offset that, and therefore doesn't have to provide the 85% required stable funding. I think it's about as simple as I can phrase it. And I think we're going to have a look at these numbers just to see if they throw anything out.
Yes, so thanks, David. I think that's as good as an explanation of NSFR as I've ever heard you give. Thank you. I've heard it a few times. Rhona, so I mean, the reason that we want to look at the trade data is because with the change of regulation, with the new rules coming in, obviously the LBMA trade data project, which you study very, very closely, and you write every month for NASDAQ on this, as well as for your clients at StoneX, you might expect to see some change in behaviour, and if there is any change in behaviour as a result of the new regime, then it would show in the data. So can you talk us through the two charts that we've got here, what they're showing us, and has there been any change in behaviour, or is there anything you think which stands out pre-Jan 22 versus afterwards?
Not really, Adrian, no. If we look at the chart to the right, I apologise for this tabulation here. Something's obviously gone awry between stage Z and stage Y, but hopefully you'll be able to make this out. As far as annual changes are concerned, The next slide will show it more clearly because I've broken them out into their individual sectors. But just on a stacked histogram here, you can see that volumes were coming off in the middle of last year when the price actually wasn't really doing very much. The price may be steady, but the market action is always interesting. There's a very big difference between a boring price and a boring market. So what we've had here is essentially increased activity in the first quarter of last year, stabilizing over the middle, and then picking up again in the first 3 months of this year. And I think as far as specifically the NSFR is concerned, probably the keys here would be the forwards and the loan lease deposit categories. So as far as spot was concerned, there was very little change. It's just a very, very, very small decrease. Stops and forwards were actually higher in the first quarter of this year against the first quarter of last. And I will defer to David as far as market activity is concerned there. But certainly it's possible that we have seen some activity moving into price spikes, and I'll come back to that in a tick. Options are also higher, which to some extent reflects increased volatility, but loan, lease and deposit, they were down by 8%, as David said, is more related to central bank activity. But one thing that I would point out is that something that comes up almost invariably, it doesn't matter whether it's gold, silver, platinum, palladium, or for that matter, any other commodity which has any kind of degree of market liquidity, almost every time, not exclusively, but almost every time there is a change in price direction, then that is usually the days when volumes are heaviest. Now, that makes sense. It's perfectly intuitive, but the numbers, time after time, the numbers back it up. And basically, one can see that that is effectively twofold. One is that when a price is moving really quickly, then the momentum traders get involved and the algos kick in and so on and so forth. And then similarly in a reversal, because people will be stopped out or they'll have trailing stops, whatever it might be. But the other side of things, of course, is that if a price is changing direction because of a change in sentiment for an exogenous reason, then almost by definition, you're going to get some people, let's say it's gone up and then it's coming down again. Some people will lock in a profit from the long side. Some others will come in on the short side. So you almost always get this bunching of price activity when things are changing direction. And the classic that we've had most recently was in the second week of March, when gold was sprinting up from sort of 1950 up towards 2050 over the course of 4 days or so. The spot volumes ballooned massively. So we had from underlying volumes of anything between 14 and 25 million ounces per day over the previous 2, maybe 3 weeks. On the 8th, when it went up to its peak, we saw 30 million or 30.1 million ounces go through in spot. And then the following day, as things slammed into reverse, it was just shy of 29. We also had higher volumes in the forwards, a little bit of action in the options, funnily enough. But what I do think was interesting, again, I would defer to David on this one because he's the expert here, is that there was a substantial increase in activity in loans, lease and deposits as the price came off the top and came sliding back through 2000 again, which suggests to me that there was some hedging being locked in. But David, I'm sure will have additional views on that. So Taylor, if we could go over to the next slide, please. Thank you. Spot takes up typically, over the last 15 months inclusive, spot on the total has comprised 58% of the recorded turnover from the LBA figures. Swaps and forwards are 31%. Options, it won't surprise anybody, are down towards the bottom end, they're at 4%, and loan lease deposit is just 7% of total. So the big action you would expect to be in spot, but swaps and forwards dwarf loan, lease and deposit. But again, you can see the rising volumes in spot, an increase in improvement in activity in swaps and forwards. Options, no discernible trend, and again, that's a function of volatility or more to the point, lack thereof. And then loan, lease deposit, you can see was busy in the third quarter, and then down in December, down a little bit in February again, but picked up again in March. So there's no direct causal link, as far as I can see, between NSFR kicking in London in January. There may be, it's not to say there isn't, because of course so many different elements make up a market. There's a lot of elements in any one daily equation. But I would say that you can't hold it up as a red flag would be my conclusion. David, I don't know how you feel about that.
Yeah, well, actually, that was, I think one of the regulators said that to us, that they looked at it possibly a bit earlier, but I think when we spoke to the banks, that a lot of them didn't wait for Jan 1, that they were telling us that they were having to prepare for this earlier. And so any sort of reduction in the balance sheet because of NSFR would have probably happened earlier in the year, but you're right, we can't see anything that sticks out in January that says people were reducing their balance sheet. So because you'd expect to see it. I mean, it's a bit like the next subject we're going to talk about with the Fed and their balance sheet reduction. You would see the spike in volume, first of all, as people tried to reduce their positions, and then a tailing off, and that certainly doesn't seem to have happened here.
Do you think that action in September, October was people actually preempting it and not necessarily reducing the balance sheet initially, but actually getting a whole load of stuff out of the way and then bringing it down?
Yeah, it could have been that, and it could have also been with the price moving up, that we could have seen some larger amounts of forward selling, and of course that's facilitated by the commercial banks tapping into the loan lease deposit market from the central banks. So that would also bear that out as well.
Okay, thank you very much, guys. I think it's interesting. Just one final question, David, if I may, for you. Are there any product groups which aren't part of the carve-out?
Well, the carve-out only really applies to the balances that the banks hold that facilitate the customers' unallocated credit. Right. So so to answer your question, then, if there was a forward trade for a bank that had a customer on the other side, no, that's not carved out. So that's not part of the interdependent asset and liability right. Because it's really designed for the banks that act as a utility to facilitate the settlement. And that's what the carve-out was designed to do. If we were going to see any change in that, that really needs to be addressed through gold's claim to be a high-quality liquid asset. And any further relief would come in the form of gold being included as an HQLA, and then it would move on to it would be part of the LCR, the liquidity coverage ratio. So in other words, you could hold gold as your pile of HQLAs representing your next 30 days of outgoing. So I think that's that's the work that needs to be done from an association's point of view.
Okay, excellent. Thank you very much. Okay, moving on swiftly then to our third hot topic of the day. Now, the US yield curve inversion. One of the prompts for this was that viewers might Good Morning Britain, I think last week, and he said there's a thing going on in America at the moment called 10-2. And when you look into it, obviously, he did actually explain it a little better than that. But I thought the fact that it was making breakfast TV in the UK is really something. Taylor, if we go to the next slide, and we'll just see what Mr. Lewis means by 10-2. So this is the 10-year US Treasury yield, the rate of annual return you're being offered on a 10-year US Treasury bond, minus the rate you're being offered on the 2-year. Now, obviously, 2-year bonds are much shorter term, 10 years. Long way out now, so we're looking at 2032 before those mature. And basically the 10-2 yield curve, the spread on that, is really taken to be indicative of what does the bond market think is going to happen to interest rates between the 2-year horizon and the 10-year horizon. And as this chart shows in the blue line here, basically when the 10-2 goes negative, i.e. 10-year yields are lower than 2-year rates, the implication is that you've got a recession coming because the market thinks interest rates are going to fall some point between 2-year horizon and 10-year horizon. And if you look at this chart, those grey bars, vertical grey bars, they show you US recession. And you can see that, yes, 0, you then have a recession. Now, it's pretty variable. It has happened before every US recession of the last 4 decades and more. It's also happened once when, well, a couple of times when there wasn't a recession that followed. If you just see, there's a tiny little drop below in the mid to late 90s. You then had a stronger confirmation on that move in early 2000, and then you had the recession of 2001. But pretty much it looks pretty solid. However, there's another curve which people look at. If we go on to the next slide, Taylor, which is the 10-3, and that's where we take the 10-year Treasury minus the 3-month Treasury rate, so a much shorter term interest rate. And that's in red on this chart. And you can see that this has been a much stronger indicator of a recession coming, because it hasn't dipped below 0 unless there's been a recession pretty soon afterwards. And if you look over on the far right of that chart today, you can see that whilst the 10-2 did go negative, 10-3 really isn't. 10-3 is going higher. And that's because obviously the Fed have been sitting on 0 interest rates and have only just finally got around to raising rates. So the 3-month rate is actually rising very quickly at the moment and is rising faster than the 10-year yield has been rising. So that really doesn't give us a recessionary signal right now. If you go on to the next slide for us, Taylor, you can see that I've circled those 2 points. That's the non-confirmation that we had of the blue line back in the mid to late 90s. And again, it really isn't what we're seeing at the moment. The red line is not going towards 0 right now. On to the next slide, please, Taylor. And you can see what we've got here is the San Francisco Fed did a paper back on this in 2019, Engstrom and Sharp, just before the last yield curve inversion, which may or may not have signaled the COVID crash, frankly. They say that there's no need to fear any spread on their analysis. They actually worry whether there's reverse causality at best on this, that people see the yield curve go negative and then they start behaving as if there's a recession coming. If you behave as if there's a recession coming, guess what? There's a recession coming. So that's their take on this. What they do posit a better measure, a more reliable measure on this, has actually been to take a couple of shorter term interest rates. They take, I think, the 18-month versus the 3-month. I've proxied that here on this green line with the 2-year minus the 3-month. And again, you can see that 3-month rates right now are, the 2-year rate is rising much faster than the 3-month at the moment. So at the moment, the bond market is telling you that interest rates are going to rise from here. They're not, we're not seeing a recessionary signal such as we may have in the 10-2. Rhona, can I come to you on this and get your thoughts on, what do you think is going on here? Is there any value in the yield curve signal, and what should we take from these different versions at the moment, do you think?
Yes, I've got a couple of comments there, Adrian. One is that it's arguable that the yield curve itself is demonstrating uncertainty, because to sum it up, it's been all over the place over the last week, 10 days or so. And particularly the 2-year, 10-year, and also the 2-year, 5-year, they've been flipping in and out, only very, very marginally, it must be said, with inversions of one another, while the 1-year has stayed nice and low and flat. So that's suggesting there's a degree of uncertainty within the market. But I went through the Fed's minutes this morning from the March meeting. There are a couple of interesting takeaways from this, and basically I'm more or less quoting from the minutes themselves. But there's just 3 things I'd like to pull out in terms of what the market itself is thinking in the first instance, which was on the basis of options prices in the bond market and the staffers within the FOMC were suggesting that the options prices, certainly running up to the date of that meeting, which is the middle of March, was suggesting that despite the recent correction, there's a high probability, my parenthesis, within the market expectations, close parenthesis, that prices will remain or yields will remain high in coming months. Then as far as market rates were concerned with respect to the hikes at the March meeting, futures prices had been expecting 25 points, some of the participants wanted 50, but were prepared to accept that 25 was a sensible thing to do given what's happening in Ukraine. But futures prices were implying a 170-point rise through year end, which is roughly 70 points higher than what was priced in at the time of the January meeting. So when you tie that in with the fact that demand for labour is well and truly exceeding supply, and many businesses struggling with hiring and, more importantly, probably with retention, and the fact also that the wage push is now moving out of the lower quartile and it's starting to move up the pay scale, then the Fed's got a very interesting balance that it has to strike between trying to keep inflation under control, because now they're at maximum employment, the other leg of the dual mandate obviously has to be front and center as far as they're concerned. But also they don't want to choke off too much of the recovery, given that we've still got a hostile supply chain environment, which has been exacerbated by the Ukraine issues for all the obvious and tragic humanitarian reasons. But something which I think has passed under the radar is that Ukraine is responsible for something like 50% of the world's neon supply. And neon is key for laser engraving and semiconductor chips. So that supply chain, which looked 2 or 3 months ago as if it was starting to ease off ever so slightly, has now it's had another twist in the tail. So you put all those things together, and I don't think you can argue recession, but it might be viable to argue for stagflation. In which case, that's supportive for gold. Well, so is recession, to be frank, because people diversify their portfolio and they go into risk-off mode. But I would say that either of those two environments would probably be supportive for gold rather than outright bullish.
Just moving to the next slide, because Rhona, this is one of your slides that you wanted to put in.
Yes, you can see that it's sort of
interesting here, I think, is that
with each other, haven't they?
And what's interesting, you've got higher bond yields across the board, though. I mean, it's typically one would assume all other things equal, and they never are. But higher interest rates, high bond yields, typically would pressure gold prices, because obviously
depends why they're rising, doesn't it?
Yeah.
Because if they're rising because of inflationary fears, but they're staying negative in real terms, and in nominal terms in Europe, which is still the case for most of the way across the curve, then yes, that might act as a headwind. But if rates are rising because of inflationary concerns, then that brings gold into the argument as a haven against risk.
Yeah. Interesting on your next slide as well, Rhona. If we move on, Taylor, just looking at the yield curves for different economies.
Yeah, what we've got here,
across here,
the blue profiles are Europe. The finer line, which is the lower one, is of 1 month ago, and the thicker line is this close of business from Thursday, close of business Tuesday, or early yesterday morning. So that's Europe down towards the bottom.
So the curve has moved substantially higher then?
Yes, it has. But it's also tailing off ever so slightly across the 15 to 30 years. Then the really aggressive one is the States, which makes sense with what we've been talking about. These bars down at the bottom here, these are the changes in absolute terms. So you can see the massive increase in the differences between 1 month and 3 years over the course of the past month. And then it tails off again, steadies to flat, and then really further out comes down. But what is particularly interesting here is that it's as far out as, this is 5 years, between 18 months and 5 years out, US interest rates are now higher than those in China, which in some ways won't come as much of a surprise, because we've got the common prosperity exercise in China, which is short-term pain for long-term gain. But with Shenzhen and now Shanghai going into lockdown, that's taken a bit of a kick in the teeth over the last 6 weeks or so. And there's going to be a tail risk behind that, without any shadow of a doubt. But what I find interesting is that the markets overall still seem to have confidence that the Chinese common prosperity program will work, because you've got the interest rate curve still remaining positive. Now, I've no wish to sound contentious, but there is a logical reason behind this, which is that the United States is permanently in election mode, and China isn't. So China, to some degree, has a better control over its economy than the Western democracies.
Very interesting. That's a very interesting point. David, in terms of control, you wanted to have a look at this slide, the next slide for us as well. David had an interesting point on this when we were discussing today's webinar. Taylor, are you okay to move on to the next? Thank you. So this is total Fed balance sheet. So these are the Fed holdings, and you can see the big jump there, obviously, from QE. Particularly, this is COVID QE. You can see in the middle there. Rhona, you made some notes.
I did. Well,
what's interesting in terms of control.
Well, you can see here that the expansion is roughly equivalent to that of Japan's GDP. But again, looking at the Fed minutes this morning, there is an implied criticism of themselves to the extent that they don't quite say, we have learned our lesson, but they get jolly close to it. I do think they actually use the term lessons learned with respect to the runoff of the balance sheet between 2017 and 2019. And it looks
as if they just allow it to reduce naturally by maturity.
Yes, exactly. Whereas this time it's going to be more engineered. And the point that they were making was that the caps, again, this is implicit, but my reading of it is that the caps, which were actually pretty small in terms of the amount of liquidity that they were prepared to take out of the market when it came to looking at what the definition should be of, quote, ample reserves. The clear implication was that they were a little bit too cautious last time around, and that the runoff will be sharper this time around. They said it almost. They said 3 times that it'll almost certainly be as of the May FOMC meeting, but no indication was given beyond the fact that it looks as if it'll be stronger than it was in the last iteration. They didn't give any indication as to what the order of magnitude might be, which is fair enough, because they did say that they've got to monitor things really closely. And when you look at all the other different elements that's going into what is going to drive Fed monetary policy, that's not at all surprising. But this is massive.
Yeah. Yeah. And the point that David wanted to make on this, if we go to the next slide, Taylor, David, you pointed out that because the Fed owns so much of the treasury bond market, that it means that the yield curve or any signals from that might potentially be just become noise rather than actually showing you what the market is doing, because the Fed has become. And this chart shows you the yield curve on municipal US bonds in the blue line, which is perfectly positive. And you contrast that with the orange line showing you the treasury yields, where you can see that the 2-year and the 10-year are pretty much equal when this data was taken yesterday, and that you've got the 5 and 10 negative, whereas in munis you've got a very positive yield curve moving there, and of course the Fed isn't squatting on a huge chunk of that market through QE. So David, I don't know if you've got any other comments on that.
Yeah, that was why I wanted to bring it in. I think I don't watch them as closely as Rhona. And so my ears pricked up when I heard Martin Lewis say what he said. But I was just looking for another proxy. And so I just looked at municipal bond market, and they sort of start and finish at the same places, don't they? Without this bit in the middle. And as you quite rightly say, the US Treasury doesn't get involved in that. And I was also looking at other developed jurisdictions just to try and find out if that was appearing in other markets, and of course it wasn't. So if you take the view that US recession or the potential of it is definitely contagious, why haven't we seen this in other markets? And Rhona was just talking about China there, but we can look at Australia, United Kingdom, Germany, all got positive. But that was until the Fed minutes, of course, and the monthly cap at 95 billion seems to have changed a lot of that. And I think when we decided to put this on the agenda for today, I think we were running sort of flat to 3 points negative, 2 to 10s. And having a look last night, unless I'm wrong, it looks like positive 15 again. So maybe all this clarity is unwinding in the market now. That everything's catching up. Looking back at those grey recessionary lines from the late 1990s and early 2000s, I remember there were groups of people called Fed watchers, and they used to spend weeks looking at match sales, system repos, and trying to put the jigsaw puzzle together about where Fed policy was going to end up. Whereas nowadays we don't have to wait so long. We can read the minutes, the messaging is very clear, and they're deliberately trying to inform the market of the direction. So I think it looks like the original 210 signal to beat, therefore, was a false indicator of coming recession. Hope I don't have to eat those words.
Okay, thank you, David. Taylor, have we got any time for Q&A, or I think we might be running up against the clock?
We do have some time for a Q&A, and there are a few questions, I believe, waiting in the wings for you.
Yep, okay, thank you. I think one to, well, possibly Neil and Rhona, with Russian supply of gold to the London markets now blocked, effectively, does that pose any risks to the broader market? I mean, is that a supply crunch potentially for London bullion?
From my point of view, I'd like I say, if you look at the numbers, it's a small percentage of output from GDL refineries. You made the point that Russia's closest, but there's plenty of logistics that could come in and cover that shortfall.
I think Neil's pretty much answered that in its entirety. The only possible comment that I might make, she says, with half an eye on the nickel market recently, is that if there's an increased perception of risk, it may be that risk officers will be watching things that much more closely. So it might be that you might find that spreads rise or margining may rise. But that's peripheral.
Thank you. Yeah. Neil, another one for you. Has LBMA ever taken a blanket decision before? I mean, I know that you know these are individual refiners, but has LBMA ever? I'm just trying to think. Has there ever been any example of a country being taken off the good delivery list?
No, and even in the case of the six Russian refineries, we were not taking Russia off the list. We were taking specifically 6 Russian refineries off the list. So no, we haven't blanket taken a group of GDL. Although, having said that, as I'm thinking, you could argue if one country only had one refinery, North Korea, for example, used to have a good delivery list refinery. Technically, we took the whole country off, but yeah, we deal with refineries, not countries per se.
Right. Okay. A couple of questions about Russia seems to be the hottest of topics. A couple of questions, maybe Rhona, regarding the Russian central bank's decision, or its announcement that it will buy gold at a fixed price. Does that potentially invite Russian banks to try and import gold into Russia, which they can then sell to the central bank at a fixed price? I know there's been some debate in the last couple of days about where that fixed price is relative to the global price because of what's been happening in the ruble. But Rhona, do you have any thoughts about whether Russia might actually become a source of demand for? Well,
from what I was hearing on the BBC this morning when I was struggling into consciousness, was that I'm pretty sure I picked up that an additional number of Russian domestic banks have been put on the sanction list. So the first question to that is, would it be possible or risk-free to actually take a Russian domestic bank as a counterpart? The other is that I gather also that the central bank is at the moment not buying from, this is in the press, is not currently buying from the domestic banks, which is what it said it would start to do again, because they've taken VAT off small bars, I believe, and there's been a massive surge in domestic demand. So the central bank, I understand, is standing back and letting the domestic banks feed into the domestic market. That may be one of the things that's underpinning the question that's come up here. But I think that the rate determining step there is the political facility or otherwise of actually dealing with the banks themselves.
Okay. Just, I think perhaps one last question, and Neil, I'm going to direct this to you. The fact that new Russian outputs, new Russian refined bars are now not good delivery, if that has an impact on perceptions of existing Russian brands, you know, what's the LBMA's position on that? I mean, obviously it's a commercial decision if a commercial entity wishes to buy a particular brand or otherwise, but what's the LBMA's position on that?
Again, reiterating the message is that they remain good delivery before the date, they're not good delivery after the date. Does it create a perception in the market that we should probably avoid all Russian bars? Some institutions may take that view. All London good delivery bars are created equal, but some are more equal than others, and that's always been the case. As an ex-refiner, there's no bitterness there at all.
Yeah. Okay. Right. Well, thank you very much, everybody. I think that covers pretty much. We've had lots of questions in. Thank you for those. I've tried to summarise them as best we can. So, Taylor, back to you.
Right, thank you to our panelists, Adrian, Rhona, David and Neil for joining us, and to our attendees. If you do have any questions following on from this webinar, please just send us an email at ask@lbma.org.uk. We'll forward them across to our panelists and they'll get back to us with an answer. Moving on to other LBMA webinars and events. We have 2 live webinars coming up in 2 weeks. So sitting just outside of our regular webinar series, we have a webinar on REACH. And as you can see here, it's on the 19th of April and it will take place at 2:30 p.m. at BST. So that's what you need to know. How does that affect you and your business? And we'll have Emmy Richardson, Compliance Officer at LBMA, and also we'll have Carolyn Brabant. I hope I've pronounced that correctly. So they'll be taking us through everything in terms of the basic setup for REACH and again, how that can affect your business and what you need to know. 2 days later, we'll have Rhona returning to our screens. We just can't get rid of her. She'll be joined by Jim Steele from HSBC and Suki Cooper from Standard Chartered, and they'll be continuing their 4-part series for this year, talking about inflation, central bank policies, and the macroeconomy. So details about how to register for those will be up on the website. In June, we have our LBMA virtual training on the 9th and the 10th of June. So an introduction to Loco London, and then our follow-up course, how to use Loco London respectively. So if you do want to know more about all of those aspects in terms of OTC trading, what part LBMA plays, all the information can be found on our website and the training microsite. So that's what we have upcoming, and for now we say goodbye. So again, thank you to the panelists, thank you to our audience. We hope you enjoyed this webinar, and we hope you have a lovely rest of your day.